Welcome to EWF Bootcamp day number 10, Risk Management. In today's video, we will learn why it's necessary to control the risk in our trade and how to do it. To understand why risk management is necessary, we first need to understand what a trader is. A trader is essentially a risk manager. His or her job is to protect capital and manage the trading risk. In trading, losses is part of the business and must be accepted as a cost of doing the business. Every business has revenues and costs cost always is going to be incurred, regardless what kind of business it is. But as long as the revenue is larger than the cost, then at the end of the day, the business is still profitable. So in trading, the result is not measured in a trade-by-trade basis, but rather it should be measured in a series of trades. In other words, you could start trading and losing one or two trades, consecutive trades, but that doesn't mean that the result should be measured in the first or second trade. It should be measured in a series of trades to allow your trading system and trading edge to work out. Now, risk management is probably the most overlooked by new traders due to the unwillingness to take losses when they should have been taken, and because of the hope that things get better or positions go back to break even. The number one reason for failure of many traders is poor risk management and inappropriate position size or over leveraging. Okay, so how to do the risk management? This is the steps. Number one, prepare a trading journal and plan every single trade with limit order, the stop loss, and the target profit. So this is similar to the trading journal that you see in the live trading room. Every trade that you plan to take should be planned and analyzed beforehand to avoid making a mistake. Now, after you plan your trade in the journal with your limit entry and the stop loss, then you will be able to know your risk in terms of the pips or in terms of the dollars. Then the next step is to calculate the right position size by always risking the same amount of equity each trade, at most 2% risk. So this is the formula right here. The risk capital multiplied by percentage of risk equal to the dollar of risk. And then you divide the dollar of risk by the stop loss, then you get the position size. As an example, if you have your capital is 20,000 and you're willing to risk 2%, then you multiply 20,000 to 2% and you get $400. This is the amount of your risk in terms of the dollars, and you divide that by the stop loss of the trade. Let's say the trade has an 185 pips stop loss, then you divide $400 by 185 pips stop loss, and you will get your position size, which is 2 mini lots or 2.16 lots right here. You can also do the same thing and automate the this position size right here by going into our website elliotwith-forecast.com/position size calculator, and then you can input some numbers, some parameters there, and then it will give you the result. And then finally, only when a position is already risk-free, meaning only if position doesn't have any risk anymore because the market has already moved in your favor and because you already move your stop loss to break even to your entry level, only when it is risk-free, then you can open a new position and risk your account again. So if you want to have multiple simultaneous positions in your account, let's say you want to open 2, 3, or 4 positions at the same time of different instruments, then you need to make sure that each one of them should have even less than 2% risk. Let's say if you want to open 2 positions and you want to risk at most 2% of your equity each time, then each trade therefore should only have a 1% risk. Here we take a look at an example of using the position size calculator. We will look at it also in our website next. This is an example. Let's say if you want to buy euro yen at 122 with stop loss at 121, so this means it's 100 pips stop loss, and let's assume that the risk capital is 100,000 US dollars, and then the current rate from the US dollar yen is 117, and we are willing to risk 1%. So this information is something that we need to find out beforehand, and then once you know this information, you input that information. So you can select the account currency. Let's say your trading currency, your trading capital is a US dollar account, and let's say it's 100,000 US, and you are willing to risk 1%. Then you select the pair you want to trade, and you input the number of the stop loss in pips, and then you also input the current rate for the US dollar yen. So sometimes when you trade the cross, then you need to input another information here, which is the the current price or the current rate for another pair. Otherwise, if you are trading the US dollar pairs, then you don't need to input any other price for other pairs right here. Then when you input all this information, you click the calculate button right here. It gives you the result. This means that you can trade 117,000 position with this kind of information, that is 100 pips stop loss and 1% risk to trade the euro yen. So it gives you information you can calculate. I mean, you can trade one standard lot or 12 mini lots or 117 micro lots. So let's go to the position size calculator site. Again, it's elliotwith-forecast.com/position size calculator right here. So let's say that your trading capital, your trading account is in US dollars, and you start with 100,000, and you put down the risk percentage. Let's say you're willing to risk 1%, and you are trading the euro yen. So you click this and you select the euro yen in the drop down box, and then let's say your stop loss is 100 pips, and then the price. Sometimes you're asked to input some other pairs rate here, especially if you're trading across. So US dollar yen, let's say the current rate is 117. Then once you input all this information, you click this button right here. Then it tells you what is the position that you can open for this trade. So in this case, you can open 117,000 position for the euro yen, or equal to one standard lot, 117 micro lot, or 12 mini lots. Thank you for watching the video. I hope that this video helps you to do risk management for your trades. I see you again in the next bootcamp video.